So here to share how he's positioning is Fundstrat Global Advisors Head of Research, Tom Lee. He is, of course, also a CNBC contributor. First off, Tom, I want to mark a milestone because it is now a big anniversary day for Fundstrat.
It is indeed. It's our 11th year since we started Fundstrat, which was September 15th, 2014.
Blink of an eye.
It's a blink of an eye, yes, because this is still mid-cycle for the bull market as well.
All right, so since you said mid-cycle for the bull market, let's get right into the record highs that we are seeing. If it's mid-cycle, that kind of implies maybe third, fourth inning, maybe fifth at the latest. Is that how you see things for this rally?
Yeah, I mean, I think some parts are later cycle, like part of the Mag 7 trade. But I do think AI still has many years to just propel earnings surprise and innovation and economic growth. So I don't think it's late, like it's too late. It's not too late to buy the Mag 7. But I think the next leg of this is really the Fed cutting, helps the ISM get back above 50, brings down mortgage rates, so it's a cyclical broadening trade. And then I think, financials I think are still important because I think that they're going to re-rate more like technology stocks. Goldman and JP Morgan are basically technology companies now. And as they embrace the blockchain, they're going to become more streamlined and less employee dependent, much more AI driven. So I think there's a lot to look forward to.
Now, if that is the case, you mentioned that it's because of a possible rate move lower and a trajectory of lower interest rates. Just how critical will it be to this market to have those lower interest rates? And do you think that there is a post-Fed playbook for what those companies are going to be?
Yes, I think it's really important for CEOs to be confident the Fed is cutting because we know the labor market has slowed, maybe even wobbling. And that's because businesses are cautious, and the ISM reflects it. It's been 31 months below 50. The Fed can actually re-inject confidence by saying we're back into an easing cycle. That helps businesses get confident and expand again. So there's a lot of legs to this if the Fed cuts, and I think it'll be a real improvement in liquidity.
You alluded to some of the places that could see the biggest impact.
Yes.
But can you take us through those? If you had to put a top three together about where you think the most activity or juice could come from if the Fed were to embark on this path. I think of maybe home builders. I think of other parts of the market, maybe technology based on valuations. But in your mind, what are the places that are going to reap the most benefit from that?
Yeah, so I'm looking at September 98 and September 2024 as the playbook, because those are both years where the Fed was on extended pause and they cut in September. The number one trade is NASDAQ 100. So I think that's why the Mag 7 and the AI trade gets a lot of liftoff. The second is monetary liquidity sensitivity, global central banks easing. That's Bitcoin and Ethereum. And seasonally strong, I think they could make a monster move in the next 3 months, like huge. And the third, of course, is interest rate sensitives. That's really small caps and financials. But really, the first two might be the standout trades.
All right. Because you mentioned the crypto side of things, you're actively involved now. It's not just a thing that you're doing on the side. You are very much engaged in the business of crypto. You govern, you oversee crypto assets now. If we were to say Ethereum, Bitcoin, we try to bucket them into risk-averse assets or risk-on type assets.
Yeah.
Is it fair to look at them that way? We used to compare them correlation-wise to the NASDAQ 100. Is that the fair assessment for how these things trade in the coming months?
Yes. Bitcoin is particularly monetary policy liquidity sensitive. Ethereum has elements of being sensitive to liquidity, but it's also part of this AI moving onto the blockchain and Wall Street moving onto the blockchain and that whole stablecoin ChatGPT moment for crypto. So Ethereum, I think, trades almost like 1971 Wall Street, which was the dollar went off the gold standard, a lot of innovation. Ethereum essentially is a growth protocol, and that's why Bitmine is so aggressively acquiring Ethereum.
What industries are going to see the most immediate impacts of the benefits of being on a blockchain like Ethereum, for example?
Oh, well, there's enormous benefits. Well, number one, stablecoins have proven that moving money is really good for consumers. Stablecoins are a way for unbanked people to actually have banking access. And merchants like it because they don't suffer from chargebacks. And we've seen it at BitMine because we are moving money onto the blockchain, right? We receive fiat money, we put it on the blockchain and buy Ethereum. It moves with a lot less friction. So Wall Street is building on the blockchain because they can rebuild a lot of their infrastructure on a public chain, really improves trust, and there's a lot of resilience and censorship resistance. Banks' biggest cost is labor. That's something they can save by moving onto the blockchain.
We've talked in the past about tokenization of markets, specifically the stock market. Is that something that is perhaps better indicated for certain types of blockchains versus others?
Yeah, there is already a lot of effort to tokenize. Robinhood is leading that effort for retail investors. Tokenizing stocks, which allows you to trade it 24/7, which is a benefit, and with a lot of transparency. They're building these on Ethereum or a layer 2 of Ethereum. So Ethereum, which is the second largest blockchain after Bitcoin, is where Wall Street is choosing to build these tokenized securities.
All right. Tom Lee, with all things Fed, rates, stocks, AI, and of course crypto as well. Thank you very much. We'll see you soon.
And I just want to thank CNBC. They've been a great partner and helped a lot of investors.
Congratulations on your 11th year anniversary at Fundstrat. Tom Lee.
Thanks.
All right, up next.
Thank you, Sarah and David. Welcome to the Halftime Report. I am Frank Holland in for the Judge Scott Wapner. Front and center at this hour, the fate of the rally as we count down to a high-stakes Fed decision. Our investment committee standing by to game out the expectations. Joining me for this hour, we do have Joe Terranova, Liz Thomas, Steve Weiss, and Jim Lebenthal. We're going to do a quick check of the markets before we get this discussion going. Stocks sitting very close to record highs as we await that Fed decision, but you got to see the red there on the board. The S&P pulling back fractionally. The Nasdaq pulling back about 0.5%. Nvidia, a part of that story. The Dow up about 0.75%. We're going to get right to our senior economics reporter, Steve Leisman. He's in Washington with much more on what to expect from the Fed. Steve, good afternoon. Good to see you. I think the question on everybody's mind, 25 basis point cut, that seems like the most likely outcome. But is there really a chance of a 50 basis point cut?
I just lost.
I think Steve's having some technical difficulties right now. I see him pointing to his ears. I'm just going to toss this around. Joe, I'm going to come over to you. Do you see the possibility of a 50 basis point cut actually happening? If you look at the CME Fed Watch, 96% chance of 25 basis point cut. It seems to be the consensus we're going to get something. Is 50 basis points possible?
I don't think so. I think you get 25 basis points, and I think the more interesting dynamic surrounding this afternoon's Fed meeting is how many dissents do we get? We potentially could get 3 dissents. That's the first time since 1988. The dissents will be regarding what you're speaking toward, which is we should get a 50 basis point cut. So I'm interested to hear from Steve at some point what he thinks they should be doing with the balance sheet. We've run it down to somewhere around 6.6 trillion now. Maybe we need to start buying MBS instead of letting those securities run off. But I think today is going to be about a 25 basis point rate cut with dissent.
All right. I believe we have Steve Leisman back in D.C. Technical difficulties resolved. Steve, coming back over to you. I'm going to ask you the same question that Joe just answered. Is that 50 basis point cut potentially on the table here?
I think it's on the table for maybe people who want to dissent, Frank. I don't think that's where the Fed is going here. They go into this meeting, you have a couple lackluster job reports. You got a pivot by Fed Chair Jay Powell and Jackson Hole towards the dovish side. Markets have confidence in the cut today and 2 more this year. So I just want to go through, Frank, real quick, how the Fed might signal more cuts to come. 3 places to look. Look at the level of concern with weak jobs versus sticky inflation from tariffs. Look for changes to the dot plot. It's going to show the rate outlook for the committee. And look for potential dissents in this regard, showing how much leaning there is for tighter or looser policy on the margin. Back in June, it's the latest Fed forecast. 7 officials saw no cuts this year. 8 forecast 2. That made the median just barely 2 here. That could go to 3 today, affirming the market's view of multiple cuts this year. Another issue, the one Frank brought up, possible dissent in favor of 50 basis points cuts. But there you see Stephen Myron, the new Fed governor, unpaid lead options from CEA, sworn in as Fed governor right there, reflecting President Trump's desire. Does he reflect his desire for a drastic decline in rates? He could be joined by 2 other Trump appointee governors, both of whom are candidates for Powell's job as chair. It may be offsetting that, though, a dissent on the more hawkish side from some Fed members more worried about inflation than jobs. So a rare possibility of dissents on both sides, Frank, unless Powell does what he often does, find a way to forge consensus on the committee. I don't think that consensus, Frank, is in the 50 basis point rate cut today.
All right, I want to go to Jay Powell, the press conference, obviously, after the rate decision. How do you expect the tone to be? Could we potentially see a hawkish cut here? And if so, what would be, Jay Powell, in your mind, with your expectations, what would he be focused on? Because a lot of concerns about stagflation, but just yesterday, we got a much better than expected retail sales report that seems to signal at least more strength in the economy than we feared.
Yeah, this is weird. I see the Atlanta Fed GDP now running at 3.3% for the third quarter here. And I see a lot of economists on the street with a 1.5% full year GDP number. So we're going to have a real slowdown in the fourth quarter to get there, or we're not going to have that slowdown. I really think Powell's going to try to be measured here, give the market the minimum of what they want, hold open the possibility of additional cuts this year, but not necessarily promise it outright, because I think he wants to hold on to the flexibility. If things coming in, Frank, the way you suggest, stronger than expected, if that inflation from tariffs ends up being worse. Our CNBC Fed survey, Frank, I think it's important, said substantial amounts of price increases are yet to come from tariffs. There's a limit to the extent to which the Fed is going to be promising much lower rates while that inflation rate is moving away from its target of 2%.
All right, Steve Leisman live in D.C. Steve, I know you got to get over to the Fed for that decision in the news conference. Thank you again. Liz, I want to come over to you. Just talking about a little bit about what Steve talked about, these dissenters. We're going to get that dot plot. Yep. There's potential for some of these dots to be just kind of out of the range of the rest of the group. What would that signal to the market?
So the dot plot in June it had a lot of dispersion. It was really heavy on the no cut side and then really heavy on more cuts. So what I think we'll see this time is, first of all, base case being, I don't think a lot changes in the summary of economic projections. So I think that they're going to use their ability to just not change their projections for 2025. The dot plot itself probably starts to look more dovish. So I think the weight of it starts to look like more cuts in 2025, but the average still probably signals only 2 for this year. I think actually the devil will be in the details of the dot plot and all of the summary of economic projections for 2026. And some of these, the market moving events, the potential for a market moving event is if we see something like the unemployment projection move up, or if the Fed starts to signal that they're seeing more cuts necessary in 2026. But right now, there's a pretty big distance between what the market wants by the end of 26, which is 6 cuts total from now until December 26. The Fed is only signaling 3 cuts between now and then. So if those two numbers start to move together, I think the market will like it. If they don't, we have the opportunity for volatility.
To your point, Bank of America out with a note lowering their U.S. growth and Fed outlook. Saying, a number of issues here, the lower U.S. growth, Fed yields and dollar outlook. They now expect the Fed to cut 125 basis points, 50 this year, 75 next year, less than a lot of people were thinking before we came into this meeting. Joe, I see you going, maybe, maybe not. Steve Weiss, I'm going to come over to you. There is the possibility of a hawkish cut here. How do you think the market will react?
I think the market may take a knee-jerk reaction down, but then again, it's off to the races. This market is a market that's unconcerned with valuation or fundamentals. It's only concerned with direction and feeds off direction. So what people will focus on, perhaps what they should focus on, is that as much as I don't like to engage in trite sayings, you don't fight the Fed, pure and simple. So whether it's 75 bips this year or 50 and 75 next year, it just doesn't matter if you take an intermediate longer-term view. Short term, you can't keep hitting new highs every day with the lack of news, right? And in fact, you can argue that a lot of news is negative, including, to Joe's point, the 3 dissenting votes, which, if that's what occurs, are politically driven and gnaw at what should be an independent Fed. So I think the market looks okay here because I can't find a reason for it to go down, and the currents are just too strong driving it higher. And, if they do cut, then obviously that's positive, hawkish or not. I don't think anybody expects Powell to be overly dovish anyway. But the counterpoint is, what does he say about inflation? Inflation has been ticking up. Now, it's going to continue to move higher with tariffs unless the Supreme Court comes out and says and affirms what the lower court has alluded to, which is that you don't have the power to do this.
Right. Steve, to your point, Evercore out with the note headline, "Don't fade the Fed," basically saying the backdrop for global equities remains compelling. They're maintaining their S&P price target for the end of this year at 7,400 as the Fed begins cutting rates. And we also transition into the strongest quarter of the year for equities. Jim Leventhal, you've been waiting patiently. Your views on this Federal Reserve meeting, the J. Powell press conference, cuts expected, the tone may be the market mover here.
Yeah, well, I'm happy to go last because I wanted to see if something that the three of you said would change my mind. Here's my hot, exciting take. I have never been more bored in advance of a Fed meeting than this one. I mean,
is it by what we said or the meeting?
No, you guys are terrific, and I was just hoping that there was something that would get my juices going. I don't care. I mean, this is the most telegraphed 25 basis point rate cut that I've ever known. As far as the dissensions, they're there. We know they're coming. And, you know, when we talk about what Chairman Powell may or may not say or what the dot plots may or may not indicate, let's face it that these things change and they change rapidly. I don't care if we're looking at Fed funds futures markets or the dot plot or any particular economist's projections about where the Fed funds rate will be or what Steve Leisman was saying about economic growth. It always changes. What really matters to me is that the economy is strong, that 3.3% Atlanta Fed GDP indication is very strong. Sure, there's some cracks in the labor market. I'll tell you what's more exciting to me is tomorrow's weekly jobless claims, because we had that blip up last week. It may have been fraudulent claims in Texas. I want to make sure that that indeed was a blip. That's more exciting to me. We don't have any meaningful earnings. Joe, I see you looking concerned at my lackadaisical approach.
No, I'll tell you why I'm surprised.
There's no earnings to see. That's what I want.
Hear this out for a second. I'm surprised because you have been one who has advocated for the broadening out, who has said it could reach the cyclicals, it could reach small caps. I am focused on what we're seeing today. I keep going back to the Fin 5. Again, you have 4 of them, ex Morgan Stanley, making 52-week highs. I don't think you need to trade down to small caps based on a rate cut. I think you get the broadening out in large cap financials and industrials. But this is the moment that those who believe the small cap trade is about to awaken. This should be the catalyst, right?
Whether it's small caps or the broadening, you know, the equal weight S&P 500, your Fin 5, whatever you call that. I like that, by the way. Today's Fed meeting isn't the substance, to me at least, on which any segment is going to go higher. I need earnings. Okay. Now, every indication is that the third quarter earnings season is going to be great. In particular, note that the negative revisions going into the third quarter have been very, very low.
Jim,
that's a positive sign. But the problem is, this week
isn't a positive catalyst for cyclicals. By the way, we're going to show
it's already priced in.
Industrials,
it's already
materials, and financials since Jackson Hole, and it seems like you may have a case here. They're outperforming today, but if you look since Jackson Hole, they're underperforming the market. But don't you think that a rate cut, especially for the financials, that's a big tailwind?
The market anticipates. Look at the financials. Look at Citigroup. I mean, the market anticipates. We know that. And Steve, this is, I think, what you were saying about a market that continually goes higher. At some point, it's got to give something up. I wouldn't be surprised if this is a sell the news deck.
You know, first of all, I'd just like to agree with Jim on something. I wasn't bored until he spoke, but if I look at what he's saying, the reality is the market has pulled forward not just one cut, but multiple cuts, because there's no other reason for the stocks to be where they are and for the broadening that we've seen. But if you take a look at the Mag 7, you don't really need the broadening. That's where the performance has been. That's where the performance will be. Now, of course, you just can't only own those. Most managers, I can be very concentrated, I am. And to me, diversification is the enemy of performance. But there will be a broadening out because at some point, institutional investors will say, you know what, I just can't pay those multiples. I can't pay the multiple for Broadcom, as we discussed. I can't pay the multiple for maybe Microsoft is a bad example. But they're going to look for other places to put money. The problem with that is I look at Caterpillar, which has done quite well. That's not cheap. You know, so where do you go?
The last several weeks, it has been a Mag 7 story. And I think that's the conflict right now for money managers. Yes, absolutely. But there was this apparent belief that we were going to see this dramatic broadening out, whether by equity size class, geography, or sector. That really hasn't unfolded to the fullest extent in 2025. And I think this is the moment where, okay, if you're waiting for it, if you're waiting for this pivot, this should be the catalyst.
You know, Joe, you're factually correct. I just want to point out on the other side of what you're saying, the gap between the equal weight S&P 500 and the market cap weighted S&P 500, while it's still in favor of market cap, unquestionably, is a lot lower than it was this time last year or the year before. Now, I do think the rally is going to broaden. We're seeing it today. This is just one day. I think that gap can actually close by the end of the year. That's my call. I think that broadening of the rally
here's a
will
question
occur.
for you. Do you think that's a fundamental trade or a catch-up trade, the broadening?
I think it's fundamental.
Catch-up.
I mean,
Joe, back to your point. Evercore also out with the note saying.
Wait, I like that
Hold
catch
on.
up.
There's a debate here, Frank.
That's a good point.
It's a catch-up. And after this, Frank, you can take it wherever you want to. The catch-up trade from small caps to large caps is what is going on. Small caps have been underperforming large caps for a long time.
Yep. Not in recent weeks, though.
Not in recent weeks, but the thesis has been, okay, we have this rate cut that's coming. We've got a new rate cut cycle that's coming. This is when small caps shine. In reality, small caps don't start shining until you're, let's say, 200 basis points into a rate cut cycle, because that's usually paired with a recession.
So then what's the last few weeks been? Because Jim's over here saying the market anticipates.
It's a catch-up. It's a catch-up, not an outperformance.
Okay.
So there's a short-term catch-up trade that could happen through the end of the year. But reality says, if you look even at history, when you have an adjustment cutting cycle, so the Fed cutting because they can, not because they have to, large caps actually outperform.
Right,
you go, sister. There you go. Yeah.
I want to go back to one other thing that, Jim, you were saying. You're kind of shrugging off this Fed meeting. I do think there's some other issues, some questions about Fed independence. Two very smart people, Ken Griffin, also Roger Ferguson, former Fed vice chair, both have said there's a lot of concerns about Fed independence, how it could raise inflation, raise bond rates. That could be a threat to the market. Liz, do you have any thoughts on that? That dot plot that we were just talking about, those outlier dots, they may signal that one member, maybe two members, not only dissenting, but perhaps trying to jockey themselves to be a Fed chair or stay on the Fed board.
Yes, I mean, so I think most of the dots, if not all the dots, are just going to move down a notch. So everybody getting a little bit more dovish. I do think that there are probably going to be some outliers calling for maybe even 4 cuts by the end of the year. But knowing that that's not actually going to happen or change the trajectory today. So yes, I do think that's a risk. I think the bigger risk is actually in the comments, and I say this almost every time I'm on Fed Day. The most dangerous time to trade is between 2 and 2:30 p.m. Eastern time. So you get the data, but we haven't heard from Powell yet. So it's an important time to just be careful.
Liz, don't mean to interrupt you right now.
Yep.
StubHub just opening up for trade right now, looking at the trades. 25.61, I believe, right now, just going public. We just heard the bell right here behind us at post 9. Big round of applause again. StubHub trading right now, looking at the shares right now, up just about 8.5%, 9%. Obviously, we're showing you the tick by tick now as it just begins trading. We're going to check back in on StubHub. But again, shares opening up for trading right now here at the New York Stock Exchange. A little fluctuation, but right around 8-9% in general. So sorry, Liz, go ahead and finish your thought.
That's okay. So let's say Chair Powell comes out, even if we get a more dovish dot plot, Powell comes out and has hawkish comments, something to the effect of, don't expect this to be the beginning of a rate cut series, right? Maybe we're not going to do it every meeting. And then the market interprets that hawkishly. To your question about the yield curve, what happens? What I think would happen is what's called a bear flattener. So you see the 2-year yield rise, you see the 10-year yield rise, but the 2-year goes up more than the 10-year yield. So you get this flattening effect in the curve, which would generally be negative for equities.
By the way, I just want to note StubHub up now about 9.5%. So we're seeing an upside move starting to plateau a bit. Again, just going public right here at the New York Stock Exchange just a few minutes ago, now up about 10%. Joe, I want to come over to you. Any concerns about Fed independence? Concerns that we've heard from, again, Ken Griffin, Roger Ferguson, a lot of other very notable investors concerned about what that could mean for both inflation and bond yields?
Well, I think you could maintain two different perspectives. As a citizen, you look at it and there's an obvious concern about Fed independence. Then you look at it from the market's perspective, and maybe it's to Steve's point where the currents are just so strong that it seems to disregard anything that's perceived to be a negative. But the market's telling you right now it doesn't really seem to be concerned about Fed independence. I think most important, beyond anything else that we discuss, is earnings. And if you tell me that earnings are going to continue to be strong, if you tell me that profit margins are going to maintain their level for S&P companies up at somewhere around 13.5%, they keep moving higher, then this is going to continue through the remainder of the year. I understand we're at the beginning of a rate cut cycle. I don't think the premise is you need rate cuts to stay anchored to equities. Just think about at the beginning of the year, the expectation, the consensus was you were going to get rate cuts. Coming into this year, people expected more rate cuts than we've ultimately gotten, which to this point has been zero. So I think it goes back to earnings, and I think right now the market itself doesn't seem too troubled in answering your question about Fed independence.
Well, after this year, and Jim, I'm going to come over to you. What are strong earnings? By the way, Bank of America raised their 2026 forecast to 10% year-over-year growth, also raising the back end of their 2025 forecast. So, Jim, 10% in 2026, is that the strong earnings?
You're looking at 14%, Frank. That's what you're looking at as the estimates are right now, and that's pretty darn strong. So to people who say, and I understand this, look, I look at the market multiple trading around 22 times next year's earnings, and I say, stroke my beard a little bit, that's a little expensive. Not if you're getting 14% earnings growth. Now, the question is, will you really get that? And I think the third quarter earnings season is very important. I'm going to kind of repeat what I said. Negative earnings revisions are a lot lower than they usually are at this time of year, whether you're looking at the third quarter or the year ahead. And that's an unmitigated positive. Now, I'm going to back it up with an anecdote as well. I think we glossed over too quickly. You reported the news about StubHub going public. That's great. How many times, Frank, Liz, Joe, Steve, how many times in the past few weeks have we heard that bell ring? How many times have we heard that hullabaloo behind us? It's happening a lot more. The capital markets are strong right now. You're seeing more M&A activity. You put all this together, low unemployment rate, directionally the Fed is going down, deregulation, a budget bill that's stimulative. Sure, there's risks. And Steve, I'm in large agreement with you about the Supreme Court. And if they overturn that, the tariffs will overheat the economy for sure. But right now, look, it's all engines go. It's all ahead flank.
And to Jimmy's point, and I'm speaking directly towards how we are allocated, we have over 30% weighting towards large cap financials. And I really believe that financials as a sector, while the valuation is approaching getting somewhat rich, okay, it could be rich and it could stay rich for far longer than you could expect. But it is about an increase in M&A activity, in investor engagement and regulatory relief. And I think that's one of the reasons why these five money center banks are recording 52-week highs. It's one of the reasons why American Express is right along with them. It's reasons why asset managers and private equity and brokerage are all trading near highs.
This is one of the things that troubles me. Number one, when you have a massive IPO cycle and massive issuance, you go back to the laws of supply demand. And if you have so much issuance coming in, we see it most often in biotech, where everything's great, then all these companies come, they issue equity, whether it's secondary IPO, and it crushes the index. So we could get to a point, it's not anytime soon, where all the new issuance, right, takes the air out of the market. The other issue is, and I share your sentiment on the market, is that can't find any reason for the market to go down. But something always happens, and generally it's a surprise shock.
Yes.
Right? So that's what does it. And it's impossible to plan for those because you don't know where it's going to come from. Right? So finally, what I'd say is that the danger here, and what I come back to, is that at 22 times, right, as the valuation in the market, that's usually where you get to in an easing cycle. However, that's the jumping off point for this cycle. So can we go to 26 times? I don't really doubt it. I don't really think so. But all we have to do with 14% earnings growth is what happens, then the market will go up. You don't need multiple expansion. You just follow the earnings growth.
Jim, I want to go back to your point about how many times we've heard that bell. You and I have been here at least 4 times, I think, since when a company's gone public right here at the New York Stock Exchange. So a lot of excitement when these companies go public. But if you look at the performance after that, I'm looking at Circle. It's about 50% off its post-IPO pop. Figma, 60% off its post-IPO pop. Bullish, more than 50% off its post-IPO pop. Liz, I'm going to turn to you. What does that say about this market? The fact that, as Steve mentions, we're seeing a rush of IPOs, but then after that first day pop, double-digit declines.
Yeah, well, and I think it was Steve's first comment on the show was that the market isn't paying attention so much to valuations and fundamentals, it's paying attention to direction. So there's been a lot of hype. I mean, first of all, we've had kind of a drought of capital markets activity. So there's been a lot of hype. There's a lot of excitement about the fact that there's this revival. And I think that's correct. We should be happy that there's a revival. But maybe we get a little ahead of ourselves just because we have hype around an IPO. So I think it's good that maybe the market comes back down to a more rational place quickly. We don't want things to look euphoric for extended periods of time, because that's when you start to worry that we're way too frothy and prone for a bubble bursting. But I think we have to be careful looking at the IPO market. If things are coming out really, really hot, just control your expectations about where they're going to stay.
Jimmy, I'm going to give you the last word.
Yeah, well, IPOs are not my cup of tea as an investor. However, your point factually made, Frank, if you look past the first month or so, some of these IPOs are actually recovering. I'm looking at CoreWeave, and the danger here is to be anecdotal. I realize that, but if you look at CoreWeave, it had that massive pop, it had that massive sell-off, and now it's gaining traction. I think what happens, and we know this, is when IPOs come out, there's an investor class that gets the allocation or rides the immediate aftermath when they come public, and then takes the quick gain. That begets some selling, and then the real fundamental investors come in. And I just don't see, whether it's CoreWeave, whether it's Circle, whether it's StubHub. I mean, there are fundamental reasons that certain investors will like these companies.
All right, now here at halftime, I'm going to turn to final trades. Jim, you're up first.
Qualcomm. It's had a little bit of a lackluster year, but it seems to be making a run for the roses right now.
Weiss.
Vertiv. Look, this is high test beta. So if you get a bad Fed comment, then this will go down a lot. But overall, the trend's still higher with data centers.
Liz.
China. Let's avoid Fed volatility today altogether. And I think that there's still stimulus coming over there.
Yeah, hard to believe we didn't mention NVIDIA and some of those tensions in China. Joe, last word.
Northern Trust's been running in place for the better part of the last 3 months. I think it's going to break out to the upside.
All right, one more quick check of the markets right now. Again, Fed decision coming up at 2 p.m. Eastern. J-Powell news conference at 2:30. Right now we're seeing the Dow up just over 1/3 of 1%. The S&P pulling back 1/4. The NASDAQ down more than 0.5%. That does it for halftime.
Hey, I'm George. This is Blue Cloud Trading. It's Wednesday, September 17th. Market is closed. We just saw Tom Lee. Now, Tom Lee was on a couple of days ago on Closing Bell, so I missed that clip, and I thought I'd share that with you guys. And then at the end, of course, you probably noticed some clips from today's episode of the Halftime Report, where they talked about, what to expect, especially after the Fed came out, right, with its outlook. And markets are actually reacted pretty, all over the place. I mean, you can see here, looking at the Dow, for example, it was flat all throughout the whole, pretty much the entire time. A little volatility here where it moved up, then it moved down, and then it finally finalized around the same, just slightly up, 0.57%. So the Dow was up 0.57. The NASDAQ, it dropped, and then it kind of recovered. So that was only down 0.33. S&P 500 was very close to yesterday's closing price, down just 0.10%. And the Russell 2000 was up slightly, just 0.26%, as you can see right there. Just a little volatility during that announcement. Some of the things that he talked about. Okay, let's see. Yeah, basically the Federal Reserve cuts interest rates by 25 basis points. Projections show 2 more cuts for 2025. So that's the thing to keep in mind. Let's now take a look at the index here. This is the S&P 500. You can see the individual stocks. They've actually added a few more map filters here. We can actually look at the NASDAQ 100 to get a better picture of the, some of the top companies here. Like NVIDIA was down 2.63%. Microsoft down slightly. Broadcom was down 3.84%. Apple was up 0.35%. Amazon down 1%. Google down 0.62%. Meta down 0.42%. Tesla up 1%. Netflix up 2.33%. So you can see, for the most part, the NASDAQ 100 didn't do terribly here. If we look at the S&P 500, mostly in the green. If you look at the Dow Jones, just NVIDIA was the big, it was down the most, 2.63%. All right. And then we also want to take a look at the groups. And let's see how the sectors performed today. This is the sector performance for the 1 day here. Consumer defensives, financials, and utilities were up the most. Healthcare was up too. Technology, industrials, basic materials were the bottom performers today. But they didn't really drop that much. I mean, technology was just down 0.47. All right. And this is what the 1 week performance looks like. Pretty much still in the green. Let's get into this ETFs now. Here's what we're going to do. We're going to talk about the stocks and ETFs. Not all of them, but a majority of them that they talked about on both of the episodes that we just saw there. We're going to look at this. Start off with the S&P 500, Qs, these ETFs. We're going to look at some of these stocks, including Tom Lee's Fund Strats Tom Lee of Fund Strat's Granny ETF. We're going to look at that. That's a new ETF that he has popped out there. Mag 7, we've got 4 stocks that we're going to cover. We're also going to cover the sectors today. The strongest sectors have been highlighted with a little blue flag. And same thing with these, the indices. So, and then we've got a request as well from one of our members. So let's take a look at the SPY first. Let's start off with that. And let me just move this for a moment. Let's make this chart big so we can see better. All right. What do we got going on? Well, if you look, we're still above the moving averages on the daily chart. So the trend has not changed at all. Like I said, it was, the SPY was down just 0.12% today. Nothing major, nothing major. The QQQ ETF did the same thing. It pulled back down 0.20%. In fact, it's showing some strength towards the end of the day. You can see what happened here. Price, okay, dropped all the way down to that level, the 583.33 level that I have drawn based on that prior high. So this trend line has been here for a bit. You see, I created that one back on September 11th, and you can see that it came down, touched it, and then got, the buyers came in. You can see all that buying taking place on the 5-minute chart. So here it was. This was the bottom down here at around 2:55 p.m., and then it just started moving up about 0.96%, back above the cloud on the 5-minute. So that looks good. Dow Jones up the most, right? Today, 0.54%, holding up above that support level. Interesting how it came right down, touched it. Okay, touched the Tengensen. The green line is the 9 period. We're using the Ichimoku indicator, folks. And there's the 26 right there. They're all in the right order. Price is above the cloud. Price is above the moving averages. In a very strong uptrend still. Russell 2000. Okay, even though it was only up 0.26%, and it actually today did, in fact, close under the 9 period. But I'm not overly concerned about it, and I'll tell you why. I mean, you can see that price came all the way up to that level, tried to basically break above that 244.98. Not enough. Basically, I think what happened was, they knew the small caps would do well in the event that the Fed cut by 0.5%, right? So there was a little bit of enthusiasm. You can see all the volume. People were setting up for that potential. And then when that didn't actually, occur, you can see price dropped, right? So here's the 3-minute chart. Let's look at that for the day. And so here you can see the enthusiasm, right? Right before the Fed, people were starting to set up their positions, and then they got the bad news. All right, around 2:06, what time was that? 2:09 p.m., and then things started to drop. Okay, so you can see from that high there, it dropped approximately 2.87%, but then started moving up a little bit. So, but ultimately, from the prior day, it was up 0.26%. So interesting. So I'm still bullish on the Russell. Yes, it had a big volume here, but if you notice, it's still holding up above these lows right here also. So it's got support. The other thing I like too is if you look closely here, the directional movement index, that volatility helped to create this where the ADX is moving up. That represents momentum. The positive DI is moving up, negative DI is moving down. That's all good. So I think tomorrow I'm very optimistic about tomorrow. I think tomorrow the stock market's going to do pretty good, actually, based on what I'm seeing. And I'll give you some more proof in a second. FEZ, the Euro Stocks 50 ETF, pulled back a little bit. Here it is, holding up above the Tengensen and Kijinsen, down 0.61%. Nothing major here either. But the thing that's giving me optimism is the VIX itself, because the VIX, where it was actually for 3 days in a row, was moving up, right? We talked about that in prior shows. Here, and here. Today was down 3.91%. What happened was it came right to the Kijinsen, the 26 period, the red line there, and started dropping. So that's a good sign. We don't want volatility to increase here. We want the volatility to stay at these levels. These are conducive to a more stronger uptrend in the markets. Granny stocks. This is Tom Lee's ETF, and this one here, as I mentioned in the past, was stuck in this little consolidation box. It broke above that box back here on September 10th. It moved up for 4 days. Now it's just basically moving sideways right here, right? I think there's nothing really to be concerned about. What's interesting today, though, is the fact that price closed, okay, at the exact same price as it closed yesterday on Tuesday. So if we hover here for a moment, if you look at the closing price, and you can see that there's a little box that populates over here on the left side. Look at the top, and you'll see the price. See what it says GRNY 2465? That's the closing price. Okay, and let's look at the next candle, 2465. So that's interesting to me that it stalled right there. So I think, again, I think it just needs to break through this little, it's basically now just consolidating a little bit right in that little tight range. If we can get above it, expect an expansion. FXI, here's an interesting one. The China large cap ETF, which has outperformed the US S&P 500 quite a bit this year. Not too happy about that, but it is what it is. Here we are on January 3rd. Back here, if we look at the charts, it's actually moved up approximately from January 3rd, Friday, January 3rd, it moved up 39.22%. Okay? You can see that right there. And it's still moving, and it's still going up. And here's the weekly chart, also looking very bullish. Okay? How about the S&P 500? Let's look at that exact same picture. And let's go back to January. Let's go to the daily chart here and go to January for a moment. There we are. Right around January 3rd. This is January 3rd. Whoops. Right there, right around there. Up 11%. So China's up threefold compared to the S&P 500. Not good. And this whole incident here with the tariffs didn't help. But even so, the market, once of course we reversed course with the tariff situation, didn't make it as bad as it could have been, things started to recover. But it's taking a long, took some steam out of this whole situation, which could have, all we needed to do is break above that 613.23 level, and we would have been basically up in these levels, much higher. Anyway, so that's FXI. Let's take a look at CRWV. This is CoreWeave Inc., Technology Sector Software Infrastructure. Here's a weekly chart. Doesn't look bad here. You can see that there's not a lot of data here because their initial public offering was back here on March 28th of this year, right there around $39.10 was the opening price. $39 was the opening price of CRWV on that date. Okay. And then it's moved up basically around, 205% or so. At one point, it was up at these levels here. It was up 367%. Now, how do I know that? You can see the box populate down here in the bottom part. If I hover here and then hold that and just go all the way to that top part, do you see where it says in 2.8 months, 367.5% annualized? 81,250%. So what happened since then, though? Since that day, June 20th, it actually dropped. It's very volatile, right? It dropped about 54.87% down to $84. So it went from 187 down to 85. And now it's at 120, starting to recover. Let's look at the daily. All right, it's still not technically a place that I would be interested in because you can see what's happening here is we've got a series of lower highs. All right, so that trend line is still in play to the downside, and we could see a reversal here. We got the Ichimoku cloud as resistance right above, not looking that great in my opinion. Now you could also argue though that this is a double bottom pattern, and we did take out this high, right? But we haven't established a higher low yet. This is still moving up. Maybe if it comes into the cloud, pulls back, and then breaks through the cloud, that's what would make sense to me, right? I'd like to see that. And of course, I'd also, at the same time, would probably be breaking above this prior high. Then all of a sudden, you've got something. If, of course, that is if you want to invest in a company that's still not profitable. It's got 39.65% negative profit margins. All right, let's go to QCOM. Here it is on the weekly chart. First, let's start off with the weekly chart. I like to look at both time frames, as you know. I'm looking for confluence, basically. I want to see both of these time frames giving me the same picture, and right now you can see the weekly chart is still weak, right? And so it's under the cloud right there, maybe barely inside the cloud, but my point is not a time to be going long here in my opinion. On the daily chart, it does look much more bullish because we did break out through that high from July 3rd. So we took out that high. We might see some short-term momentum to the upside. It might find some resistance at 176, maybe another 6.5% move up potentially before it starts to stall, in my opinion. So just keep that in mind, okay? VRT is Vertiv Holdings. I believe that was Steve Weiss's final trade. Right now on the daily chart, it's inside the Ichimoku cloud, so I would not be jumping into this one quite yet. You can see here that the Tenkan-sen is still under the Kijun-sen. So the 9 period is under the 26. That means that there was a negative crossover right there. You always want that faster moving average above the slower one. You don't want the faster one under. What that tells me is there's weakness here. Now, the good news is that it did break this trend line. Do you see that right there? So we did break above it. We took out that high. We got above that high. But we're still inside the cloud. And if we look at the weekly chart, all right, it's struggling right there around that area of the Tenkan-sen. But this thing could certainly, if it can get above the high of that candle right there of 142.06, I think then it has a chance to continue moving up. What will happen also is you'll notice that the Senko span A will cross above the Senko span B. That's the light colored blue line, getting above the blue purple line. And plus the Chiku span here on the daily chart is still under price. So it's, in my opinion, it needs at least to get above some of these highs here. Maybe even this high here would make sense, above the 145.46. Before I'd be bullish with Vertiv. Let's keep going. Let's take a look at Meta. Now, these are some of the Mag 7 stocks. Meta was actually up yesterday, got above the Tenkan-sen and Kijun-sen, but today was down 0.42%. And the cloud is still bullish. Overall, the chart looks good. It's under the 796.25 level. It's got resistance about 2.5% away from where we currently are. So I'd hold off on Meta. Here's the weekly chart. You can see it's kind of stuck in this little range here. Tesla. Today, up 1.01. This is the weekly chart. For 3 weeks now, we've been above the Ichimoku cloud. One thing we haven't done yet is Senko span has not crossed above the purple line, the Senko span B. All right, so that hasn't materialized yet. So the Ichimoku cloud is, I'd say it's a strong trend up on the weekly, but not ultra strong because it doesn't have all of the elements of this indicator telling us that we should be going in long quite yet. Okay, on the daily chart, it's a different story. Yes, the Senko span A is above the Senko span B. Price has been moving up. Seems a little extended up here, though. This far away from the moving average is not something I'd be interested in personally. Apple, on the weekly chart, it's been above the cloud for 3 weeks, but as you'll see here, the Senko span A is still under the Senko span B, in my opinion. And we also have that high still that hasn't been taken out, the 250. And the 260 is right there, also not too far away. So not interested in Apple on the weekly chart. On the daily chart, you're going to find resistance around 4.5% away from where we currently are. In fact, we already found resistance right there at that high of that candle. You see how it developed that little shooting star? So I'd hold off on that one. NVIDIA has been declining here for a bit now. It's now not looking as good as it was, right? Because it was holding up above the cloud. Right, you can see that. We've got a lower high here from the prior one. And it's re-entered the cloud, but it's holding up above the 168.80. So it's just playing with your emotions a little bit if you happen to have a position in this. I got out of this one. What day was it that I got out? On August 29th for a 0% flat trade, basically. My prior trade was a profitable one there. And then I just got out here. And it hasn't really showed that much strength recently. All right, let's keep going. Let's go into the sectors. And these are the strongest ones. See the ones highlighted with the blue flag here? These are the strongest ones. The ones below are weak. I'll run through all of them. I won't spend too much time, though, on these either, the ones that are the weakest. Real estate. Okay, now why is this strong? Even though price today closed under the Tenkan-sen, this right here, this pattern is called an inverse hammer. It's not that often that we see that, honestly. It's pretty rare to see the inverse hammer occur after a drop in price, like we saw here. Okay? This, believe it or not, when it happens at the bottom of a move, is actually quite bullish. If you see something like this at the top after a move up, okay, and you see that formation, that's bearish. And I'll show you guys what I'm talking about. So here we are with the candle pattern reference sheet. And here's the bullish side. Let's take a look at the bullish side first. And let's zoom in on this for a moment. And let's go to the left. And here we are, bullish single candle patterns. So, as I was just saying, if price is moving down, as you see right here, and you develop an inverted hammer, which is what that is, that's a bullish sign. There's a higher probability that it will move up. Is it guaranteed? No. No guarantees in the market. Hate to tell you. But higher probability, okay? That, especially if we get above the, I think the high of that candle, the wick of that candle, that it will move up, okay? So that's the thing I'd be watching. Now, that same exact candle is bearish, depending on where you find it. So let's go to the right over here for a moment. I'll show you what I'm talking about. Whoops. Let's go to the right. Okay, now in this case, it's called the shooting star. And when you see price moving up, like it is right here, and then it develops this same exact candle, only at the top, that's bearish, all right? And if we take out the low of that candle, then it's more likely to continue dropping. Higher probability, more than a 50% probability. I'd say 60 to 70. So that's why it's important to keep an eye on the formation of candles, because they tell us a story. They tell us what's happening with price movement, okay? And these have all been tested. There's some great books out there on Japanese candlesticks. If you want to learn about, why they are significant, you can check them out online. All right, so XLRE, like I said, it's pulled back, created that inverted hammer. So I'm a little bit more bullish, and we'll see what happens with that. GDXJ, gold miners. This one pulled back under the Tengen-sen. I have left the flag on temporarily because I feel like there's a probability here that we can get right back above. It's so close to the 9 period that I'm not ultra concerned, but I would say to start thinking about taking profits soon if this thing starts to draw back further, because if it takes out the low here tomorrow, there's a good chance it will come down to the next level of support. And how far away is that? That's about 6.5% to 7% away. All right. Here's copper. That one pulled back too. Now here's the good news. That held up. So that's what I'm saying. I'm looking at all of the metals, and basically what I'm finding is that the majority of them are holding up above the Tengen-sen. Most of my gold stocks held up as well above the Tengen-sen. Here's XLC, communication services. That looks pretty good, up 0.26%. SMH looks good, even though it pulled down to 0.64%. That still looks good. NVIDIA helped to push it down a little bit on high volume. But overall, the ETF is still in a strong uptrend. Here's gold. This is my what I'm talking about here. So yeah, it dropped a little bit. Okay, but like I said, I think that we're going to see a bounce maybe tomorrow. We'll see if I'm right. XLY is holding up. That's consumer discretionary. Yeah, I pulled back under the 240.28 briefly. You can see that lower wick, but then the buyers stepped in and pushed it and closed above that level. ETH, Ethereum. Tom Lee is a big fan. And this stock here, this ETF, up 0.61%. To me, I'm a little bit, I have positions in Ethereum and in Bitcoin, but I'm more of a buy and hold in these scenarios. But if you're trading this, okay, as you can see, we've got a formation here. We've got a symmetrical triangle formation. And that tells us that we don't know what really is going to happen here until the price breaks. And I would wait for a breakout, okay? I'll show you the pattern that I'm talking about with the symmetrical triangle. It's right here. And if it breaks to the top, to the upside, then there's a higher probability that it's going to continue. That's the bullish variant. The same exact pattern, if it breaks under that lower trend line there, it's more likely to be bearish, and then it will continue to the downside. So we'll see what happens with that. All right, it's unknown. XLK, I think there's a higher probability it's going to move up. Why? Because the general direction of the daily, and if you look at the weekly chart, is still very strong to the upside. It's really that simple. XLK, technology broke above 270 on the weekly chart. Here it is on the daily chart, holding up above it. I like it. Still, even though it dropped a little bit. Financials, XLF is looking pretty good, up 0.97%. It was up the most, right? of the ETFs we just discussed. So that's looking pretty strong. Tom Lee likes the financials, and you can see that they are looking pretty bullish here. High volume. If we look at the weekly chart, still looking good. All right, now we're not going to spend too much time on these ETFs, but I'll just kind of run through them. Here's XLV under the cloud on the weekly chart, so know that. SLV, silver, looks good on the weekly, but on the daily chart today, it also broke under the 10%. I think I'm going to give it the benefit of the doubt because this, in fact, is a spinning top. This can easily pop right back above. So I'm not like ultra bullish here yet with silver, but I don't like the fact that it did close underneath, and we'll see what happens tomorrow with that one. XHB, this one looks weaker. That's home builders. Closed today under the Kijinsen. Okay. Has not taken out this low yet, though. XLP is into the cloud, so no on that one. That's consumer staples. IBIT, the Bitcoin ETF, is still kind of basically hovering right around the top of the cloud right there, but the faster moving average is still under the slow one. That's why I would hold off on Bitcoin for now as far as adding positions. Industrials, XLI, has been in a decline a little bit. If you look here at the XLI ETF, whoops, let me just draw a quick trend line for you. There we go. And you can see that decline. Okay, so I'd hold off on that one. The next one is Oil K, which stands for the ProShares K1 Free Crude Oil Strategy ETF, still under the cloud. We've got Energy, XLE, on the daily chart looks pretty good. On the weekly, however, still hovering right under the cloud there. Not good. And but it's looking more and more bullish. It looks like it might pop soon. We'll see if that happens. Utilities has found a little bounce here on the weekly chart above the 83.41, but still currently under the 10% on the weekly chart. And on the daily chart, it's inside the cloud, so I'd hold off on this one too. XLB, Select Materials ETF. Its price is under the 10%, hovering right above the Kijinsen. On the weekly chart, you know, it's not a very pretty chart, to be honest with you. I see a lower, what I'm seeing here with the, on the weekly chart is this lower low from the prior one. And it looks like it's been moving up here a little bit, but it's been stalling at that 92.86 level. All right, so those are the sectors. Let's take a look at VXX. Here's the weekly chart under the cloud. Here's the daily, also under the chart, under the cloud. What is VXX though? So let's, I got some notes here for you, just to give you a quick synopsis of VXX. Here we go. So VXX, ETN, it's an ETN, not an ETF, by the way, which is very different, right? So ETNs are generally, okay, riskier than ETFs due to factors like issuer credit risk, where the financial stability of the issuing bank directly impacts the ETN's value. Potential for greater market volatility, especially with leveraged ETNs, liquidity concerns, complexity from leveraging or derivatives, absence of dividend payments, and the risk of early redemption or delisting, which might not reflect the performance of the index they track. So these are very risky. Okay, it was down 3.5% today. Doesn't look like anything that that makes sense to be adding to your portfolio, in my opinion. Here is the weekly. Here's the daily chart. Look at that daily chart. I mean, yeah, I'd stay out of that one. I'd like, even on the here's a 4 hour. Every time this ETF came to the cloud, to the top of the cloud here, it bounced. It basically found resistance and dropped. Came right here to the cloud, dropped, and it's been dropping. It's been staying under the Kijinsen for a long time. Here's a 2 hour time frame. Okay, it doesn't look pretty, so I'd stay out of this one. Now, if you guys want to find out about how you can become members, so you can get access to some of the exclusive member-only videos that I post, stay tuned. There'll be a quick little recording here at the end, a little pre-recorded video, so that you can find out how to do that. And don't forget to like and subscribe and hit that notification bell. Appreciate all of you guys. All right, catch you in a few. So, you're coming to this channel for the first time. You may not have subscribed yet, which is kind of crazy. Can't believe that you haven't subscribed. You know, this is free. Hit the subscribe button. I'll be popping up in your subscriptions in the future. If you hit the notification bell as well, you will be notified. So where's the notification bell? Well, once you hit the subscribe button, okay, it will pop up the notification bell, and then you can select that. Another interesting that you'll notice is that you get this little plus button right next to the subscribe. That happens after you've subscribed. Why? Because they're giving you an option now to join. All right, and if you click on subscribe it plus, once again, another thing pops up, and this is the membership. This is where you can support the channel. Okay, you can either become a Blue Cloud supporter, a Blue Cloud trader, where you get access to exclusive member-only videos here under Blue Cloud Trader. Under Blue Cloud Legend level membership, you get those member videos. You can get access to day trading videos as well as the daily trade updates that I post. Now it says here under the community tab, it's not actually under the community tab. It will pop up in this next thing here. Boom. Once you've become a member, you'll see a new tab pop up called membership. You click on that, and that's where you'll find those daily posts on the trades that I've placed. What do I cover in this members only video? Like this one here, for example, that I posted just 21 hours ago on August 8th. I go over the, whoops, hold on one second, let me go back. You will see exclusive member only video. Okay, weekend update on the trades I placed throughout the week, plus new stock ideas for the upcoming week that are setting up. Okay. And all you need to do is just scroll down. You can see you'll have access to older ones as well. All right, so you get a more insight about my trading strategies and you know, the stocks that I'm actually holding, plus those 20 new stock ideas. All right, something to consider.